Good day, traders. This is Roger Scott from Market Geeks with the second part of our three-part series about short-term trading strategies that work. Before I begin, I'd like to remind you to visit marketgeeks.com for your free short-term trading report. And don't forget to subscribe to our video channel for short-term trading videos and trading tips. Yesterday, I went over some basic short-term trading strategies that demonstrated how the length of a moving average or the length of a breakout from a moving average changes your odds drastically. In a nutshell, I demonstrated the 20-day moving average, the 40-day moving average, the 60-day moving average, the 80-day moving average, and the 100-day moving average. As I increased the length of the moving average, the odds of trades becoming winners increased as well. The best result was achieved using a 90-day simple moving average. The worst result was achieved using the 20-day simple moving average. Anything after 90 days decreased the percentage of profitability. While testing the different length of moving average, we discovered that the 20-day breakout tends to produce about 29% of the time accurate trades. This is not very promising. However, if we reverse this technique, we will end up with an entry method that produces over 70% accurate trades. Imagine trading short-term trading strategies with over 70% accuracy. Today, I will show you how we can take an entry method that produces awful percentage of profitability and reverse it to produce profitability above 70%. Here are the long entry rules. The stock or any other market you trade must make a 20-day price low. In addition, the market must close at the upper quarter of the daily range. This is the filter you need to pay attention to. It will show you the stocks or other markets that are losing steam after making the 20-day low. In addition, this is a big one. You want to make sure the 20-day low is against the main trend, meaning you want to trade this method only in the direction of the main trend. Here's a visual so you can get a good feel for this method. The next step is to place an order 25 cents above the high that was reached that day. I won't cover protective stop loss orders or targets in this tutorial. That's for tomorrow's tutorial. By going only in the direction of the main trend and only picking markets that are closing in the upper quarter of the range, we increase our odds even further. This strategy has one of the highest rates of percentage of profitability I have seen in 20 years. Here are the rules for the short entry. The stock or any other market you trade must make a 20-day high. In addition, the market must close at the lower quarter of the daily range. You also want to make sure the 20-day high is against the main trend, meaning you only want to trade this in the direction of the main trend. Here's a visual so you can get a good feel for this method. In this example, you can see exactly where the sell stop goes. Remember, the market must close against the direction of the breakout and close at the bottom 25% of the daily range that day. These examples should give you a good idea of the 20-day fade strategy. Tomorrow, I will go into calculating your stop loss level and how to calculate your profit target. I will demonstrate the ATR indicator that will achieve this very easily. The 20-day fade strategy is one of my favorite short-term trading strategies that outperforms many strategies that sell for several $1,000s. I hope you join us for tomorrow's tutorial. Thank you for joining us for today's tutorial. Don't forget to visit marketgeeks.com for your free short-term trading report, and don't forget to subscribe to our channel for short-term trading videos and updates. This is Roger Scott wishing you the best in your trading.